What's your style? Traditional? Bold? Comfortable? On trend? High-tech? Diversified? Trade in your own style.
Good afternoon, ladies and gentlemen. It's 3 o'clock in Switzerland, so we start on time. I have the great pleasure to moderate you the panel on something with the title Fixed Income Back to Normal. I think something very promising. And I have the great pleasure to have 3 panelists with me. Next to me is Martin Wilhelm. Martin Wilhelm is founder of the IFK, Institut für Kapitalmarkt. He is the owner of this company. With that, he's also an advisor of the bond fund from Agatis, IFK Value Renten, something he already does that since 2008, and he invests really across the board of the whole fixed income range. He is also a book author and lecturer at the Frankfurt School of Finance and Management. Then next to him is Valerio Angioni. Valerio is investment director fixed income at Jupiter Asset Management. With that, he is responsible in presenting the whole fixed income, the investment director, the fixed income range of Jupiter, which is really globally and also across the board from standard market to extended market. And I think also from there in a great position to bring us a lot of insight of what's going on at the moment in fixed income. And then on the far right from my side, Dr. Agim Xhaja. He is CIO of the fixed income at Banque Cantonale Vaudoise. He is in the team since 2006 and also there looks in the entire range in a global and holistic view on the fixed income part. And also I think all 3 of them, as you just hear about their introduction, they're all best positioned in bringing us closer what's going on. My name is Thomas Breitenmoser. I'm leading the consulting and controlling team at Complementa, and I like to fire away with the title, Back to Normal. What does that mean for you, Martin?
So in fact, the world in fixed income has changed dramatically within a year. So if you consider, let's say, the ECB has started to increase the rates on the 22nd of July. That's less than 1 year ago. So in the old days, we had yields with negative yield, negative territory, and that has tremendously changed. So you can get, as a normal investor, about 4, 5, or 6% in investment grade. And I think almost nobody here in the room, or probably the gentleman next to me, would have thought that it is the case. So in fact, it's a new word, it's a positive word, and you can get 4, 5, or 6% in euro as a capital stream, which is a solid gain.
Thank you, Martin. Valerio, what does that mean for you?
No, I very much agree with what has been said. I think that is really an yield story, meaning that if you think about 2022, was really the setting late in annus horribilis for fixed income with very deep losses. But clearly part of those losses came also from the fact that we were starting from the very deep zero ground for fixed income. Today, investors have again some kind of income when they invest in fixed income assets, even in high quality fixed income. So there is no need anymore sometimes to reach to the very external end of fixed income markets. So clearly the yield and the income is back in fixed income. So I think that's really the story and the back to normal there.
Mm-hmm. Thank you. Agim, back to normal for you is a little bit more a critical point because yes, we see yield, but at the same time we see inflation. What's your opinion?
So I'd like to repeat what Martin and Valerio has said, but okay, you'll get bored. So 4 or 5 is attractive. Let's take another angle. What it means back to normal. Where is our debt level? Back to normal? Where is this misallocation of capital that we have spoken for 10 years? Back to normal? What is back to normal that, okay, banks fall in March and in 3 days, Fed brings it back, all this huge program there, back to normal. Not yet there. Okay, so this is a little bit long-term perspective. Are we back to normal with this perspective that we can find opportunities? Yes, we are back to normal. But we should not forget this normalization. We still have the central banks that are playing a lot of major role in our capital market. To get some carry, some opportunities, yes, back to normal. But should not forget, okay, this big perspective. If we take a much shorter perspective, let me continue on this part there, okay, because we are not doing the secular themes today, okay, between three of us, you know. If we take a bit more the others, are we back to normal? Have we stabilized? Yes, 5% in Fed fund rates. Nearly there, nearly back to normal for monetary policy in some way. Are we back to normal in terms of inflation? Yes, because we have gone a little bit, okay, down where we are. So this is how I would angle this on this part. And this type of, why I mentioned this, because, okay, this is just to throw a little bit some arrows in the party here, which is not the case. But we should pay attention. If I see all this type of high leverage in the system, a lot of debt, I should not stay too much short underweight duration. This is how I translate in my fixed income scenario, this type of things. So this is why those type of things are a little bit more this back to normal that worries us on this part.
I think probably we'll agree back to normal is we have yield, and that's definitely different, but we still have a lot of challenges ahead of us in the fixed income market. Maybe, Valerio, can you tell us how you're positioned at the moment, or where do you see the most fruitful areas in a portfolio for a fixed income investor?
Well, first of all, for us, on a macro standpoint, we do expect that we are going to see at a certain point in the coming 12 months a material slowdown. We do expect to see that in the United States, but also in other developed markets. So for us, you know, US Treasuries, but also other developed markets, government bond. I'll mention Australia, that maybe is a market that is a little bit far from us. These markets look attractive for us at this entry point. So we think that really government bonds, or if you wish, duration is a pretty much attractive asset class at this point in time. So if you wanted to define it on a, let's say, portfolio positioning standpoint, we are pretty much overweight core duration at this point. We think there is a lot of value there. But then there is also the counterbalance to that, because yes, we do expect some slowdown, but at a certain point, if you compare the situation that we have today on credit spreads, I'm thinking, for instance, about European high yield, you have pretty much wider spreads versus what we had, I don't know, in 2018 or 19. So effectively, you're still paid to, get some risk, maybe, not as much as you will be in a fully recessionary environment, but still, it makes sense also to have some credit in your portfolios. So to sum up, at this stage, our position is pretty much a barbell approach, where we put together core fixed income, so effectively government bonds in developed market, especially in the longer part of the curve, in the longer segments of the curve, and then we put together a bit of credit, maybe also in the high yield space, focusing a bit on shorter duration, more defensive sector, secured opportunities, effectively things that are more recessionary proof.
Okay. Martin, how are you positioned at the moment? Or where do you see most fruitful areas?
Probably we are buyers and sellers on the exchange, because we do exactly the opposite. That means, in other words, the liquidity will be positioned at the time, let's say, you have an inverted yield curve. That means the 1 and 2 years are very high compared to the 5 and 10 years. So in government bonds, we do invest, let's say, between 1 and 2 years, where we get the peak of the yield curve. So we have no negative, let's say, carry trade against us. That means you can get, let's say, on government bond, on France government or in Bundesgovernment, about 2.5 or 3%. And the other part, let's say, if we go to credit is still a steep yield curve. So the longer the maturity, the more premium, or let's say the more income, the more coupon you get. So in governments, short term, the most attractive yield, what you can buy on the curve. And on credits, the longer it is, the better it is. So because you get, if you're going to say invest in a 3-year paper, investment grade, probably, let's say 4%. But you get 5 or 5.5 or 6% when you go a little bit longer, 5, 6 or 7 years. So again, we do it on governments on the highest point of the yield curve, and on credits, the longer, the better.
Thank you, Martin. So it's already an interesting story here. I will go over to Agim. I think traditionally, yield curve, traditionally textbooks tell you that if you have an inverse yield curve, it's a typical sign of a recession. And at the moment today, the Fed, most likely, we just talked about it, will raise another 25 basis points on the short end, which is probably something like 5.25, and we have on a 10 years something like 3.5. So almost up to 2% difference between short-term and 10-year rates in the US. What does that give for a signal? Is that really a recessionary environment, or is there something else you look out of that?
So how we can tackle this? Okay, if we read what the others are writing, okay, they say that is a recession level without crunching the data. I have a little bit some time, so I crunch some data on this type of part, and to be honest, I've not found much of this type of prediction power of the yield curve on this type of rate. So if you want to see the folklore is saying, okay, when the yield curve is inverted, okay, it has some reasoning behind 15 months, 12 to 15 months, you will get a recession. Yes, we might get. We don't rely much on this, to be honest, Thomas. And I have done a lot of this part of the curve between 210, 310, so I have I spent a couple of years before, okay, not in this role that I have, with testing a little bit how much is predicting recession, because this is what we are after. Unfortunately, the evidence is not conclusive. So what is the difference here? Why we are getting on this point? This is the part here. Look a little bit what has happened last year. You have heard this story, okay, portfolio 60-40. Let's bring this in fixed income. When you have seen the last time that investment in treasury was negative return, investment in investment grade was negative return, investment in high yield was negative. See a little bit the picture in 2023. The three are positive this year. So we have something that is not working properly on this type of allocation, which is inflation. So until this type of thing is sorted out, and this is in the way to sort it out, then we'll become a little bit back to normal with this yield curve. Until now, we are not normal. This is another phase of being not normal. Because normal for us in fixed income means one level is the level of yield. But when you have some trouble, we buy treasury and sell corporate bonds. Last year has not functioned on this part of the thing. While this year, the way, okay, if I would follow there, we are more on this favor, means I stick a bit more to what Martin is saying, that if Fed is nearly done with the rate, if this is the rate or is another one, maybe, okay, this is a place to be in the short term of the curve. Don't bet the house immediately, okay, because, you know, we have very powerful forces, as I mentioned before, okay, Fed is a very, very, very major player in the market, so we are careful, but the opportunity is there. Where is the other opportunity? It's a little bit what Valerio was mentioning a little bit. Today, high yield, if you are selective, is 8%. Okay, you will tell me what is the macro outlook, what is the Fed, what are the fundamentals of the company, how is the risk reward. But 8%, if you close your eyes, in the next 12 months, has been nearly, okay, almost one occasion, always positive. So you know a bit when you play, okay, on which stakes are you playing? Clearly, okay, you need to be very, very, very selective in the companies that you like. But 8% yield on this type of high yield, okay, is interesting. If you will go even more for the short term, this type of strategies are more attractive. So this is the way how we are seeing. What this brings us to wrap up the question? It brings us that, okay, we are not seeing much the recession. Okay, is a little bit disinflation in a recession. It might be there, but okay, the signs are not there. Clearly, okay, we know one stuff. If we'll see recession, we know only one thing in fixed income. We'll buy duration. We'll buy treasury bond and sell everything else. For us, maybe we have a curveball, more difficult scenario, that we have this disinflation that is happening. And if this type of thing is happening, we need to be selective a little bit to go in the back end of the curve. We need to be selective in credit. We need to find some agency spreads, which are pretty interesting on this part. And especially in Switzerland, we have this letter de gage of fund briefing, which today are offering 60 basis points more than Confederation. 60 basis points for 1%. It's quite a lot of opportunity. Usually this market trade at 25, 30 basis points. So those are this type of, for this level of risk, this is what I meant. So those are this type of scenario and opportunities that, okay, we don't only stick to the yield curve.
Okay. You also mentioned at the very beginning, back to normal. Of course, it's not absolutely the same thing because we have much higher debt level, given the case that we have such a long time of zero negative interest environment. Maybe it's questions to Valerio. I just read today in the paper that back in 1999, where the president was named Bill Clinton, we had a debt level of per capita in the US of $13,400. And by then they thought, because economy was flourishing, they thought by end of 2013 there should be no debt, and there was already people thinking about what do we do if we don't have a treasury market anymore because no one needs any debt. Now we all know it's back 2023. We crossed already $100,000 per capita debt in the US. And we all know that probably they have to, again, on the budgeting, looking that there's not a shortcoming by July the 1st, which is at the moment a red sign ahead of us. So given that samples, it is somehow, and still interest going up, it feels that US treasuries maybe are not as comfortable, but you're still going long duration. Mm-hmm. Maybe it can give you a little more insight why you come to that conclusion, giving those facts which I just read today in the newspaper.
Mm-hmm. Well, I think that, first of all, it's really about the slowdown that we think is coming in the United States. And our key view is the fact that the tightening that we have been seeing for now 13 months, 14 months, will take some time to have full effects. And think about what we saw in the banking sector in the United States. So effectively for 12 months, we didn't see any kind of major volatility. No one was seeing any kind of problems. But deposits were starting to flow out of the system. Why? Because effectively you had a situation where banks were offering deposit rates still of 0.5%, but the money market was offering you a rate of 4%, 4.5%, then 5%. So effectively you started to see this flow out of deposits from the system. And that for us is a clear example of the lagged effect of monetary tightening. So we think that this kind of uncertainty on deposits that you now see in the United States, given that people effectively have alternatives for their money, is going to create a much more difficult environment for banks to lend. And if banks are starting to tighten lending standards, we saw that a few days ago from the last survey from the ECB, but we expect to see something similar also from the Federal Reserve. So if banks are tightening lending standards, again, we don't think that you can be in a very healthy growth environment. And when that moment arrives, so when people start to realize, okay, maybe banks are not lending that much, maybe that can be a problem for commercial real estate in the United States, especially for the segment of the banking system that is more exposed to that area, then is where people start to go through treasuries, start to buy duration, and maybe you recognize at that point that the position in the market is still pretty much quite short treasuries, so people start to pile out on that trade, and it's very fast. So you maybe get a movement even of 50 basis points in a matter of a few weeks on the 10 years. So if you don't jump on that kind of trade on an early basis, you're not really getting that kind of trade, I think. So it's about positioning for that change in the macro cycle that we are seeing at the moment.
Okay. I think what we learned in the past, I think the unthinkable can happen in many things. We have seen Argentina, for example, defaulting 6 times. You say, okay, Argentina is Argentina, but 6 times defaulting. So why does the US not default, or a European like Italy whatsoever? We still have this very high debt burden. We have much higher interest rate now because we are back to normal. They have to fight against inflation. Does that not bother you, Martin?
Obviously, if you look at the credit spreads, let's say in Europe, you can see 10-year governments. Italy is about 180 basis points more yield than on Bund. So you get already the 4%. So if you believe in Brussels, if you believe in Europe, you should buy this kind of stuff. If you don't, it's a different business. We don't trade this spread because everybody knows in the room we had the bankrupt not only in Argentina, we had in several other places, and obviously we had it in Greece. And we had big time trouble, 2.5 years Greece crisis. And let's say if Italy, let's say, will be in a shaky situation, all the markets in Europe, included the equity market, will be shaky as well. So this is not our trade. We don't believe in that. We have a socialism system in the sense of Eurobonds, in the sense of, let's say, target. The target, let's say, special situation with the European Central Bank. This is not our trade. And obviously, it's a sort of a risk in about 5 or 10 years' time. But if you look at Japan, you have about debt to income GDP, I think 250 to 300, and they still survive. So, and Treasury, I think a dollar is a dollar, and everybody knows, let's say, the country, and 80%, I think, of all the currency around the globe of the 200 countries are more or less linked to the dollar. So I think this is not really a big thing. A dollar is a dollar. We believe in the system. We believe rather in the system in treasuries or in US than in Italy.
Okay. Can we talk a little bit about the extended market? Well, we have seen, just given the fact that we have this...
Let me adjust that,
Yes,
Thomas.
please,
Maybe
go ahead.
It's pretty interesting, this part of thing, because people will see this Japan case, see the Italy case when it's 7%. There are two conditions that we know, apart from the trust in the system and apart from Brussels, that this thing to hold. What is the interest rate? What is the interest rate level, first? And how much, if you have heard the term, which is a little bit sauvage, you know, primary budget balance. How much is the interest rate that are paying? Both those things right now, you know, I don't think that Thomas has brought us here to make a secular case what will happen in the 10 years, you know. In 10 years, yes, might be something. But right now, we are prepped not to have this, because those two type of things, especially in US, are well maintained. Might an accident happen because, you know, they don't find the language and the others? Okay. Is a problem for the 10-year treasury that Valerio is holding? No, it's not a problem. It's a problem for some guys which are holding this, those bills that are 1 month and the others, if this accident will happen. But the treasury will, in one way, okay, never say never in finance because tomorrow will happen, but at least see a little bit this type of perspective, that level of interest rates, where they are, compared to the normal GDP, okay, that we see over long term, okay, are well behaved still, and still see a little primary budget balance is still in favor not to happen something acute. Okay, can we continue like that? No. But this is how, just to put something, because the situation is getting a little bit heated every day with this type of negotiation and the others. So we try to avoid a little bit these bills, if we used to hold.
You think it's more short-term noise?
Then worried about those coupons in 10 years, so it's on this type of issue.
I think, if I may, it's also interesting if you look at the example of 2011, effectively what happened in that period. At a certain point, 10 years yield started to plunge, equity markets had some kind of drawdown, so you had the classic risk-off scenario in that environment. So the paradox is that even in that situation, maybe actually the 10-year is doing fine. That's the thing.
Probably one thing about Italy again. So we like Europe. On the other hand, let's say if someone says, I would like to invest in a passive investment, that means in an ETF European Eurozone government bond. There's one thing, let's say, we should know about, let's say, compared to the strength or the portion of the GDP and, let's say, the portion of debt, you have a much higher percentage in debt in the ETF than the GDP. That means it's already a spread, I think, to 18 to 25. And every single year, when the debt increases in Italy, you always have, let's say, the sort of a higher market share in this ETF. So that's what somebody should know if someone invests in an ETF in the Eurozone.
Which is the part how bond markets are functioning, and many people still underestimate that the bigger debtor has the biggest holding in index.
This is the reason since a couple of years, it becomes 10 years, was a little bit unfortunate, because when this thing was coming, those fundamental indices that we mentioned in fixed income, because in equities means those value growth and the others that have 20 years history. But when Italy was 7%, I remember some of my colleagues in some other institution, launched those fundamental indices to avoid this, what Martin was saying, that, we are this type of in bond market, more you issue, we are more forced to buy on this type of things. And this is something which has been a solution. Until now, those have not been proven because, where Italy is trading was not this 7% when was this time of Berlusconi, government that he received this letter on this part. So Italy was coming there, and was the other episode of January. But people should be aware a little bit that exists this type of fundamental indices, especially in treasuries. We run actually a fund of treasuries based on this type of principle, this fiscally strength one, which basically you get your weight based on how much healthy you are apart from this market value, because what was mentioned here is a little bit this market value type of issue in some way.
Am I correct? The fundamental indices has underperformed so far. Is
Yes.
that correct?
Yes.
That's why probably not more is in there, but just from a feeling, analytical feeling, I think it's a good way to think
The
about
last
it.
10 years, because they underweighted Italy. If you underweighted Italy in 2012, 2013, you know the conclusion, on this part. So.
Yeah. I would like to move on more to the extended market. Valerio already mentioned a little bit on the high yield. I think something what happened in the last couple of years was really the case that everybody was moved to more risky assets, including extended market, just because you didn't get any yield anywhere. And we have seen that all the covenants on the bonds, which you're buying in, became more unfavorable for the investors. So do you see this trend going to the other side slowly, or what do we do in the extended market in there? How is the positioning there? Can you just give me a little thoughts on that point?
So if we look at the 81 market, you know the very famous story about the 16 billion here.
Where a bond is more risky than equity, which we all learned the first time in life.
That obviously at the time you would like to issue now a new 81, that means a hybrid, a bond, let's say, with some shareholder parts. Obviously, at the time, right at the moment, the investor has more the power to influence, let's say, what the coupon is, the structure. That's a good thing for the investor at the moment on 81s. And I would see it, let's say, in general, in the sense of ESG themes, that there are some yield pickup or coupon pickups of 1/4 of a point or 1/2 a point, which is not a big thing, but it's even better. Let's say you get 4.5 instead of 4%. So
on ESG, you get a yield pickup.
Yes. Yes.
Is that not counterlogical?
You get a, let's say if the corporate issues more than predicted, or which is a part of the legal framework, then they have to pay 1/4 or 1/2%
Sustainability-linked bond. Yeah. This is what he has in mind.
So the strength of the investor is right at the moment quite positive, because the risk appetite of the banks are very limited at the moment. So the corporate, if they have to finance their business, they can issue equities or they can issue bonds. If the bank is not anymore, let's say, willing to have the risk, or let's say the risk of the credit of the corporate on the balance sheet. And that is at the moment with Credit Suisse, with the banking crisis in the US, the case. The risk appetite is definitely much smaller than before. And that means, on the other hand, the investor has more the power to have the influence on the coupon and the structure of the deal.
I think, I agree with that, meaning that clearly in the last 5 to 10 years, you have a bit of a flourishing of covenant light structure. I would exclude at least the period from COVID. So you think about 2020, some companies had to issue very expensive and very, even hard debt in terms of covenants, especially those companies that were very influenced by the COVID situation. Think about cruise lines. They had to issue, very expensive debt with a lot of covenants, with a lot of security on that. Actually, there are still some structures there that are relatively interesting to buy. But yes, probably the trend in the coming years, if we stay in the current situation, will be a bit more strength for investors. I think think that in the very short term, one thing that is helping issuers, especially in the high yield market, is that you don't have a huge pipeline of redemptions or maturity coming in 2023. So effectively, there is still some time for the refinancing. It's not huge amount of time, but clearly there is some time to wait for better conditions. The problem is that many businesses today were fought for financing conditions that were much more convenient, much lower. So effectively, certain business models, and one clear example, for instance, is European real estate, where we are seeing a lot of volatility recently, cannot work with rates that are in Europe, 4% for the BTP, as we were mentioning before. So clearly, these companies can find some problems in surviving this kind of environment. So we think that clearly, if you end up in a situation where rates stay persistently high, as they are now, some business models might start to struggle. So it becomes not only a matter of what kind of covenants I get on my debt, but can I refinance this debt, or does the refinancing of this debt make sense within the structure of my business?
Thank you. Before I open for questions in the audience, Agim, do you like to mention something or add something on?
Oh, that's fine. Let's leave the audience for question.
Okay. Are there any questions?
Just on the covenant one, I mean, that's pure demand and supply of bonds. So I think you see that come and go all the time over a cycle. But one thing I wanted to say is this as back to normally. I mean, one thing you kind of touched upon, but if central banks are still the biggest player in the fixed income market, then we're far away from normality. With this in mind, I mean, you guys all talked about yields now. If you're talking about real yields, we're even far away from normality. So how does this compare if you look now versus, 2-3 years ago, when we talk real yields? Have you really improved?
Well, I'd say yes, because I don't look at real yield, at least, but then we can discuss. But it depends really on the definition of real yield that you have. So if your definition of real yield is on ex post inflation, you have horrible real yield today. But if you look at inflation expectation and what kind of inflation we might get in the coming years, I'd say that you are getting a pretty nice deal. I mean, if you look at tips today, you are locking a real yield above 1%. It's something that is not bad. I mean, we had something similar at the end of 2018, 2019. So it's not horrible, I'd say. So effectively, it clearly depends on the future path for inflation that in some way is not fully certain. But I'd say that if what inflation expectation are telling you today is kind of the path that you can expect for future inflation, so maybe not going back to the 2% or below world, but still staying in that kind of below 3% world, you're getting something decent. Otherwise, clearly, instead, if you believe in a much stronger inflation going forward, yeah, I agree with you that maybe real yield might be still a bit low.
So in real...
Question. Sorry.
Go ahead.
No,
go
please,
ahead.
please.
Go ahead.
Okay. If you see, what is the CPI for the last 10 years, if you average out? 2.6 today. Tell you, okay. So every time the 10-year bond, when he has dropped, I'm speaking for Treasury, not to every time that has dropped under the 10-year moving average of this type of things, immediately bounce. So in general, we are not like we have been in 63 to 81, where we have traded 3 points up more than inflation, this 10-year inflation. Now we are trading more to this lower part, but every time that we breach this 10-year inflation, everybody has a Bloomberg screen, everybody which has a Bloomberg screen can check this number and can see. This is serve as a sort of a lower point. So this is a little bit some part in your question. If you want to add a little bit some credit spread on this type of things, maybe yes, on the others. Now, does it hold every moment, every time? So it's not a theorem. So.
If you see it from the point of investor, for example, if you heritage some money, 100,000 or a million, and you say, I only would like to invest when I get real yields. What are you going to do? You sit on your account, you sit in your room, and you look on your current account, and you only get 1%. And you wait for 6 months and 9 months till you get the real yield. I think this is not really a good trade. And in case we will see that, say, a recession, yields will go down again. That means, in other words, you were waiting for 1 and 2 years to say, I only invest if I get real yields. But I think it's not the way to get rich.
Which is another way to admit that the real yield is actually zero, below zero at the moment, but you still have to go into bonds at the moment. Sitting in cash is probably not the right thing to get rich.
That's why stock markets are where they are, because people park the cash, not the bank.
Absolutely.
But so, to refrain it, is not what the real yield is saying. We need that money takes more value. When the money will take more value, then real yield situation will be stabilized. And these people, okay, will reprice risk correctly, because this is the stuff why we are worried to this back to normal. Because in whatever situation, without you are doing this cleaning, you will not get back to normal in the sense that money take real value. Means everybody is aware, everybody goes in buying assets or going in supermarket and seeing what is the value of the money. It's not there here. So this is a concept for the public of what we name in a little bit on this term here, real yield. Is there? No, it's not there. But will come. So in terms of investment, it's a little bit.
Probably a bit thematic. ESG investing long term, do you see that as core inflationary? And if you see it as core inflationary, do you see the Fed abandoning its 2% insistence on long-term inflation targets and its implications for duration?
Okay, you imply that ESG might be inflationary, and therefore, at the end of the day, maybe even the target of the central banks should be higher than the 2%. So that's more or less the question in there. Do you agree on that?
You are correct. If we are planning to do what we have promised to do in infrastructure, to bring all the supply chains here, to do every type of things, yes, this means that will come. Now, will be inflation target 2-3%? Okay, right now we are not seeing, but it might be that the target might be raised. There are some discussion. But as I said, okay, this is secular team. How many times we are wrong? It taken a little bit like, I have like 6-7 years before when we saw that globalization, this war with China and the others. 6-7 years that has happened. You have seen how inflation was behaving. But now we believe, okay, but this is more a believable, is on this part that we can measure or we can see in reality. Yes, if those type of things happens, guarantee, okay, that will be more. But it's too repricing of the risk.
We believe the same way that the likeliness of the adjustment of the ECB inflation target will be changed. And that's probably the next 2 years. And the question, they won't do it for 0.5%. They won't do it for 1%. What is even they think it will be 5. They won't have the strength and the power and the mentality to say we go from 2 to 5. So what is the political way? Most likely, our view is from 2% to 4%. So that means, and this is in line with the core inflation, what we see almost all over the place.
That's
so
just
we believe in absolutely what you.
That's just another way of pay back the debt for the government. Huh? That's at the end of the day what is kind of financial repression, which we talked about probably 5 years ago heavily, and that's probably the way we see it right now. Is that you would agree with that?
Game, yeah.
Congratulations, the game is going on.
Absolutely, absolutely.
On ESG, I think that probably I agree with what you were saying, meaning that it's a really secular thing, and really I think it's hard to say how these different secular teams are going to interact with each other, meaning, okay, demographics, technological development, ESG by itself, or even the fact that China is not growing at 6% plus anymore, but is growing at 6% minus in the future. So I think that can be also a factor in the long run for inflation. The possibility of reconsidering the target of inflation for the Fed, I would say, is something that is possible. However, I think that may arrive in a moment where you have really some financial stability concerns. So if they think that they are not able anymore to pursue their mandate because that will imply, some material risk to financial stability, which is the thing that happened to the Bank of England, if you think about it, in October last year. In that specific scenario, I think maybe they can, even in an implicit way, drop at least temporarily their inflation mandate. But clearly, if you enter in that kind of financial stability risk environment, then maybe inflation becomes not so sticky anymore because people are not investing anymore, because people are not consuming anymore. So I think that it depends also in what kind of scenario the Fed has to leave their target. If they have the capability to push, if the economy is fine, I think that they can go on probably.
Okay, time's up. It's 40 minutes over. Agim, Valerio, Martin, thank you very much for the discussion. I think to sum up, back to normal is the case on the yield, but everything else is pretty a different game at the moment, if I understand. And I think the biggest mistake would be just stay in cash. That's, I think that's the problem which we hear very clearly after that panel, at least to me. Thank you very much and have a good afternoon.